in interviewing the client, getting as much information as we can, and then make statements and advise him to make statement under affidavit or under oath, because the entire proceedings in this NCLT is going to be based on affidavit. Affidavit of the officer of the company or a KMP of the company who would actually certify, including valuer's certificate. Valuation certificate will also be required to be given with the full workings and details. So we have to be careful in making disclosures and interviewing the client. So equitable justice will be exercised not on the basis of the long drawn pleadings and arguments before the court as it used to happen in the High Court. On the face of it, if the pleadings and the documents which are required are on the table of the NCLT, bench officer or secretary approves it, ROC has approved it, regional director has approved it, liquidator has approved it. Now there is a notice to sectoral regulators. If everything is found to be fine, the transaction or the restructuring exercise either through merger or demerger will be approved by the NCLT. Appeal will lie before NCLAT. Again, NCLAT will be not burdened with too many issues on facts. And again, orders of NCLAT can only directly be challenged in Supreme Court. Again, questions of law, no questions of facts. So, to curtail this tribunalization is with an intent to curtail the burden of high courts. Time will only tell us as to how it is, whether it is successful or not successful. Because the entire enforcement of the Act, Companies Act, depends on how successfully or unsuccessfully NCLT works. So I would not dwell upon these things because these are all known things: reduction of capital, revival and rehabilitation of sick companies, conversion of. So all these are powers which are conferred on NCLT to deal with. Earlier these powers were with either CLP or the High Court. Now it has been consolidated into with the NCLT. Now what is the process? If you read the amalgamation rule, just I have tried to capture in brief as to what are the salient features and how it is different from the High Court rules. So you require a registered valuer to prepare a valuation report on the exchange ratio of the shares in a company where there is an exchange ratio. That registered valuer is required to prepare a valuation report and submit. The board considers that valuation report, fixes the appointed date, and also appoints a practicing company secretary or an independent auditor for preparing merger report in respect of or explaining the effect of compromise on each class of shareholders, key managerial personnel, promoters and non-promoter shareholders, laying out in particular the share exchange ratio, specifying any special valuation difficulties faced by the valuers in a transparent manner. So the board of the company will meet and do this as a step number 1. Thereafter, the company is required to obtain consents, which is the traditional way of doing things in a company where if you are closely held company, wholly owned subsidiary or there are creditors, you obtain consents. But the difference is it is no longer a consent letter, it is a consent affidavit. So the creditor or the shareholder or anybody has to give an affidavit of consent. Earlier it used to be simply a letter, and letter used to be relied upon and the court used to act upon it. Now it is an affidavit. So which means a person who is giving a false consent can be called up because he has made a statement under oath. So you need to have in a closely held company 100% of total shareholding consent so that you don't have to hold a meeting of the shareholders, or 90% of the value of the particular class of creditors so that you don't have to hold a meeting and you can claim or seek an order of dispensation of meeting order from the NCLT.
So, just a question. So this is specifically not provided in the Act. We have to approach the bench and request for one, right? A dispensation. Is it in
No, it is provided in the Act also that they have jurisdiction. As I said earlier, all these issues were open. Now they have taken care of it. All these open issues have now been provided in the rules or in the sections in some form or the other. So thereafter the company is required to file an application with the NCLT. there are these forms which are prescribed, as I was telling you, the standardized forms NCLT through all our electronic forms which are there in the NCA portal. On the same lines, they have provided these standardized forms in which you are to file and the application needs to be drafted and then information needs to be provided. One more relief they have given here is that if there are multiple companies, if there are 4 or 5 companies as part of the restructuring of the group, are merging, demerging or reducing capital, you can file a combined petition, one joint petition. Earlier it used to be 5 or 6 petitions before High Court. Now it is a combined application or petition you can file and reliefs can be different. This is most important again, as I was, this is a topic which everybody has to be mindful. This is what is sought by an affidavit. All material facts, including latest financial, latest auditor report, pendency, reduction, if it involves reduction of capital, you have to disclose that there is a reduction of capital. Details of any schemes of corporate CDR, if there is a CDR scheme which as part of the CDR scheme there is a merger, demerger or a sellout is happening, you have to give the details of report along with the valuation report. Valuation report in respect of shares, property, assets, tangible and intangible movable properties of the company by a registered valuer needs to be disclosed in the affidavit filed by the company before the NCLT. A certificate by a company's auditor that the scheme meets the accounting treatment provided in the scheme meets the requirement of accounting standards prescribed under section 133. So there is again a certification. If you see the entire scheme, everybody is certifying what they are doing. It is valuer, it is auditor, it is company secretary, KMP. You will see throughout the scheme there is a self-certification which is required at every stage either by an affidavit or by way of a report. Then on hearing the order, on hearing the application, the NCLT could pass these orders under Rule 5. So they may determine the class of creditors whose meeting or meetings are required to be held or dispensed with, fixing time and place of the meeting, appointing a chairperson and scrutinizer, fixing the quorum and the procedure to be followed at the meeting, determining the value of the creditors or the members of the creditors, notice to be given to sectoral regulators or authorities as required under 230 subsection 5. That is the most important one, which is this. Under section 235, you are required to give, along with the Rule 8 of the amalgamation rules. Earlier, a application or a petition of a merger required the notification to be given only to the regional director and registrar of companies, and later on with the CBDT, the income tax department. Now, what you require in case of all the companies, they have made compulsory that at least the notice should go to central government, registrar of companies, and income tax department. In case of listed companies, it has to go to SEBI and stock exchanges. And in case where there is involvement of or transfer of shares of a foreign shareholder or a foreign security, then RBI, official liquidator, and of course independently under the competition law, Competition Commission of India, if you are restructuring by way of a combination, amalgamation or a demerger or rather a joint venture, is approaching or is going to reach a threshold or a size. This law is an animal in itself. The CCI law, which is very stringent. There are too many penalties and filing fees are also very stiff. 10 lakh rupees and 40 lakh rupees for pre-merger scrutiny if you are reaching the threshold. But the thresholds are very high, 5,000 crores and 6,000 crores of size. But it is required by the professionals to make an application, advise your clients to make an application if you are reaching those thresholds and the combination is likely to have an adverse effect on competition in the relevant market. So that's one more regulator which is added. And any other regulator like IRDA or sectoral regulator where there are TARI or IRDA, insurance or telecom, wherever it is applicable. Then another important relaxation they have done, the rule they have provided and prescribed is that earlier it used to be that anyone and everyone could oppose the scheme. Even if you are holding one share or you are a creditor of a chaiwala of 1 rupee, you could just go to the court and oppose the scheme and stall the proceeding. Now they have provided that a scheme, though it is approved by, after it is approved by majority, which is 51% representing 75% in value, can only be objected by persons, shareholders holding not less than 10% of the shareholders, or having outstanding debt of not less than 5% of the total outstanding debt of the company. So they have provided this safeguard so that frivolous objections cannot be made to the schemes which was being witnessed before the High Courts. These are the powers: protection of minority, creditors, shareholders' rights, variation of rights. These are the powers of the NCLT. They are having wide powers under this section 237. Exit offer to dissenting shareholders. BIFR references will abate if it goes to NCLT. Now, important thing in this section they have provided is that no compromise or arrangement in respect of any buyback, as I was saying, Sterlite case. They have expressly now provided that you cannot look a buyback of shares scheme unless it is in compliance with section 68 through a scheme of arrangement. Then they have also provided single window clearance. I referred to PMP auto judgment which was passed in 94, that if a scheme of amalgamation, demerger or restructuring involves reduction of capital, you do not require a separate procedure to be followed under section 66. Single window, High Court can approve and bless the transaction of a reduction scheme, amalgamation, demerger involving reduction. So you don't have to follow the requirements of filing a separate application, separate petition, etc. Important exclusion is they have disallowed the treasury shares. Earlier it used to happen in a case where wholly owned subsidiary would merge with a parent company, and parent company is holding in the subsidiary company would be retained in a separate trust or a separate company to exercise control. Now they have banned that. They have said that you can't have a treasury share. No company can directly hold its own shares or through its associate or subsidiary company in a scheme of arrangement. Thereafter, there is a standard process. After you file the application, you have a second round of substantive petition. This is required to be filed, and there is a time-bound period within which the NCLT needs to consider that substantive petition by filing again the standardized forms in CAA 5 and all. There is a procedure which is now simplified and standardized under the rules. Certified copy is required to be filed as it used to be earlier within 30 days with these forms. Then the important inclusion now is under 232(3), you are required to file a merger working statement. So again the certification comes in within 210 days from the end of each financial year, being the working of the scheme report. So whether the scheme which has been approved by the NCLT is working properly, and whether it is having impact on shareholders, creditors, KMPs, and it is working smoothly, a report requires to be filed with the NCLT to take stock of the situation. This is the new addition. This one is the most important one for professionals, small companies. Now this is for small companies and wholly owned subsidiaries. This is a new addition in the entire gamut of restructuring, and this is most favored sort of thing. In abroad, in US and European jurisdictions, there are no courts, there are no authorities. All they do is they enter into a merger agreement between the parties, have a sanction of board of directors, executive committee, investment committee, and shareholders. They just file the report of approved merger contract with the registrar of companies or whatever regulator they have, and the merger is done. Simplified process. They have rather tried to introduce this, but with the checks and balances. This requires notices to be given to these authorities prior to or after, and currently NCLT is playing very safe because the jurisprudence is going to evolve over a period of time. Once the members becomes more experienced, they will then start granting orders before this. Time will only tell us. This is a merger or an amalgamation done by a small company which is defined under 285, which is 50 lakhs of turnover and or rather paid up share capital and turnover criteria, definition of small company.
The majority of caterers, if the caterer is being paid within 7 days of the close of the month regularly, are they, we will have to obtain the approval of the same? They are not, means
Trade creditors, trade creditors running in. So you can see dispensation on that, running account, ledger account, but you will have to make a disclosure and, on a cut-off date basis that this last month I had this creditor's balance by an affidavit. So some new inclusions I have been repeating again. These consolidation of share capital, simplify the process of wholly owned subsidiary with the parent company, allowed 90% approval given by the shareholders and creditors based on merger agreement, self-disclosure, declaration of solvency, objection and suggestions of ROC and all. So the process is that you have to file a declaration of solvency first. Based on that document, you file a proposal to registrar of companies, regional director or official liquidator as the case may be directed. Those authorities will come out with suggestions or objections, and if they don't come out with objections or suggestions, they give you a confirmation order saying that we are all happy and fine with the merger or the proposal, and that order requires to be then approved by the NCLT finally to say that yes, merger is done for small companies and it is all done. But if regulatory authorities comes out with an objection, then they will recommend to the NCLT to transfer the proceedings from a section 233 to 230 and 230, which means from a summary proceedings, you will have to have an open court proceedings, long drawn, long cause suit, or proceedings where everybody will be invited, notices will be published. This is a closed door affair, that will be open door affair. Cross-border merger, we still have to have notifications to be issued by the government on jurisdictions which will be allowed to be merged with the Indian company or vice versa. Hopefully it will come out very soon, maybe in the next financial year. Then there is a provision which was there under 394A that has been retained for dissenting shareholders, that if there are certain shareholders who are not agreeing to your amalgamation, merger or a proposal of restructuring, they can be bought over by following the process of notice, valuation, etc., which is provided in the 235. Then there is another one, last one, purchase from minority shareholder. This is the minority squeeze out which was tried by all multinational companies whose shares are got delisted and they were between 95 to 100% shareholder. So this now is officially incorporated in the rules and in the section, allowing the company to give exit options, of course by following the valuation report and valuation norms, and with the checks and balances that the money has to be provided in the escrow, transfer company will act as a receiving and paying agent, this should remain open for 1 year. All this is a revolutionary provision which can be utilized by more companies that used to happen in earlier days. Now, role of regulator, which is one more slide on this. Everybody knows income tax role, why they are required to give an NOC to a merger or a demerger so that there is no evasion of tax. SEBI ensure that listing conditions are not violated through innovative structuring to ensure fair participation and representation by public shareholders and protection of minority shareholders. Competition Commission to ensure that combination does not result in dominant market share. RBI and the FEMA to ensure that outflow of foreign exchange is managed and securities are issued transferred as per valuation norms again. IRDA, TAR and NBFC, other sectoral regulators to preserve FDI norms as to monitor indirect and direct foreign investment into the country through the restructuring under the guise of the code order or NCLT. Along with that, you have ROC, registrar of companies on the compliance of the Companies Act, official liquidator to give his report for dissolution of the company and compliance again, and regional director supervising that overall function. So these are the role, these are the regulators and the role to whom, according to the applicable facts of the case, you would be directed by the NCLT to give the notice of hearing, etc. So that there is. So yeah, 30 days time is given after the receipt of notice. If they don't respond, it is presumed that they don't have any comments to make, and therefore it will be sanctioned. Now, 2 days back, last week, in fact, Saturday or Friday, there was a meeting of SEBI, and I was told to capture this also just for the information of members here, that SEBI has come out with a new notification now in respect of mergers, and it says this: in case of a merger of an unlisted company with a listed company, with a view to improve the disclosure standards, again the thrust is given on disclosure standards, the unlisted company Indirect shall comply with the requirement of disclosure of material information as specified in the format of a bridge prospectus. Now you see, you are virtually required to give a draft prospectus or an abridged prospectus, all that information when you approach the market to raise finance in a listed company scenario from public. You have to give various disclosures and various information in a prescribed format of abridged prospectus. All they are saying that if you have a proposal, you will give disclosures as per the abridged prospectus under ICDR regulation of SEBI. Then they are saying holding of pre-scheme public shareholders of the listed entity and the qualified institutional buyers of the unlisted company in the post-scheme shareholding pattern of the merged, the combined entity should not be less than 25%. This is with the object to maintain public shareholding and to prevent a very large unlisted company to get listed with a very small company. So again, SEBI has come out with this regulation. Unlisted company can be merged with a listed company if it is listed on a stock exchange having nationwide trading terminals. This is self-explanatory. This actually comes out of Companies Act only because under 230 there is a provision that an unlisted company can merge with a listed company and NCLT has a jurisdiction to approve that. So this is in that context very relevant. In order to prevent issue of shares to select group of shareholders, instead of all shareholders pursuant to the scheme, it is clarified that the pricing formula specified under ICDR regulation shall be applicable in such cases. To ensure larger participation of public shareholders, they have now provided mandatory e-voting in the 3 cases. If the scheme involves merger of an unlisted company resulting in reduction in the voting share percentage of pre-scheme public shareholders by more than 5%, you have to get it approved by e-voting. Scheme involves transfer of whole or substantially the whole of the undertaking of a listed company, and consideration for transfer is not in the form of listed equity shares. Again, you require e-voting. Third case, schemes involves merger of unlisted subsidiary with listed holding company, where the shares of unlisted subsidiary have been acquired by the holding company directly or indirectly. In such a case also, from promoter or promoter group, you require e-voting. Companies would be required to submit compliance report confirming compliance with the circular and accounting standards duly certified by company secretary, CFO and managing director. Again, I have been saying self-certification, disclosures, certification at every stage. With this, I think I have been able to do justice to my best of my ability and capability as a lawyer in the house which is dominated by chartered accountants and company secretaries. Thank you very much for listening.
Thank you, Sanjay. You can take one or two questions.
So, Sanjay, now the buyback which is exceeding the limit, say 25%, one cannot do it under the scheme. What was earlier being followed?
To require, they have said that you can't do a buyback until it is, which means you have to follow the process which is normal, 60 days and all other things. Same issue, same shares cannot be issued within 365 days of the calendar. If you have completed the buyback, also bonus shares can be issued. All those restrictions come in.
More than 25% can you do it under the scheme?
No, you can't.
Sir, in case of merger of a holding company to listed company, listed parent, we used to claim exemption for parent based on non-only. So now this will go.
No, see, this NCLT regime is at a very evolving stage. The members are also, with due respect, have judicial background, but not as good as the High Court judges. This entire jurisprudence which has evolved right